All Things Money with David Blain. A discussion about your money, including everything from investing and taxes to real estate. Now with this week's program from D.L. Blain Company in New Bern, here's David Blain.
Hello, I'm David Blain, and I'll be your host for the next 30 minutes for an educational, entertaining discussion about your money. We'll cover actionable ideas and things you can use to help keep more money that you earn, as well as achieve or maintain financial independence. Now remember, the show is about you and your money, so if you have any questions, feel free to give us a call at 633-0107 during normal business hours, or anytime, day or night. Feel free to email us at allthingsmoney@dlblain.com. That's allthingsmoney@dlblain.com. And we'll try to answer your mail either on the show, or if it's a topic that we hear a lot about, we may even do a whole segment on your question in the future. So thanks for joining us tonight. Tonight we're going to be talking about a couple of topics, a little bit on the stock market, a little bit on the economy, and we're going to cover some taxes. So the first thing I want to talk about is the decline in the stock markets all over the world that has been happening the first part of January. As I mentioned last week, it looks like the bull market is entering into a correction phase. And what I'm going to do tonight is go over a few statistics with you and cover a few things. One of the most powerful things in investing is knowledge. And if you have a good handle on what is happening, what to expect when investing, it allows you to stay the course and maintain your investment allocation when things start to get bad in the market. And so one of the most detrimental things to an investment plan is when the markets start going, if you don't have a plan to just sell out at the bottom at the worst time. Now, there are times where it's prudent to take some money off the table and reduce your exposure to risky assets, but that's not what I'm talking about. I'm talking about the panic selling that a lot of people do just because they're not comfortable with what's going on or they didn't expect it. And so one of the things we're going to talk about tonight is the probability of declines. Now, we are currently in what I call the post-recession phase, that most people feel like the recession in America, and in fact the global recession, probably ended in June of last year. And so we're in the period, right now we're about 6 months beyond the end of the recession. And so what I did was I looked at the period between 6 months after the end of the recession and 18 months after the end of the recession. So essentially the period that we're in now, the year 2010, 6 to 18 months after the end of a recession. And of course history does not repeat itself exactly, but as Mark Twain once said, it sure rhymes. And so we're going to give you some of those facts and figures about rhyming in the market that hopefully will prepare you for what may be ahead. And so we see that in the period 6 to 18 months after recession end, the average median decline was about 14% in the market. This compares to an average gain of 22%. And so obviously if the markets are going up, people are happy and they're not too concerned about it. So there is a lot of upside potential. There have been gains of greater than 20% in this time period. But tonight what we want to do is prepare you for what may happen. And so what we see is that in 77% of the time, and these figures go back to 1928, 77% of the time, there was a decline of at least 10% in the 6 to 18 months following a recession. 46% of the time there was a greater than 15% decline, and 38% of the time there was a greater than 20% decline. And so I tell you this we've gone through a fantastic year of 2009 with returns in the market, is that to prepare you that more than likely there will be a pretty decent double-digit decline this year. The likelihood of another major bear market greater than 20% is about 38%, but it's about 50-50 if a 15% or more decline. And so I just want to prepare you for what's going on. January was a rough month, and we fully expect that throughout the year we're going to see time periods like this. In fact, if we look back at the corrections in place right now, the United States has had a correction of about 6.5% in January. Some of the other markets like Greece has had a 30% correction. If you've been listening to the news, you saw some of the problems they're having. China and Hong Kong have had about 12% corrections. But we look to later in the year, probably we'll be looking for a greater than 10% decline in the markets. Interestingly, if we go back in history, in 2009 there was only one correction of greater than 10%. It was in the first part of the year from January to March. In 2008, however, there were 3 times in 2008 where the market declined greater than 10%, then went back up, and then went back down 10%. So that happened 3 times. In 2007, it only happened once. And here's the difference between a secular bull and a secular bear. In 2003, 4, 5, and 6, there were no declines of greater than 10%. And so people became very complacent in the market. And so we've seen in 07 there was 1, 08 there was 3, 2009 there was 1, and we fully expect at least one correction greater than 10% in the year 2010. So that's just to kind of prepare you for what may occur. We don't know. We don't have a crystal ball. But what we like to do is prepare people for what the possibilities out there are so that when they happen, they're not as surprised and they don't panic and sell out at the wrong time. On a related note, the GDP figures for last quarter were just announced, and the U.S. economy grew at about 5.7%. This was the highest growth rate in about 6 years. Last year, in 2009, the GDP fell about 2.4%, which was the biggest drop in about 63 years. And so we were definitely ripe for some sort of a rebound. Myself and a lot of economists feel that you're not going to see 6% growth throughout the year 2010. In fact, some of this rebound was attributable due to companies that had depleted their inventories so much, just simply rebuilding some of their inventories back. Of course, the government stimulus, people buying cars, that adds to the GDP. The home buyer's credit also adds to the GDP. And so some of these one-time effects are not going to be there throughout 2010. So we're looking for a little bit less robust growth as we go into the rest of the year. So that takes us to our first break. And when we come back, we're going to start looking at some tax issues. And in the interim, if you have any questions, please email us at allthingsmoney@dlblain.com. For All Things Money, this is David Blain.